Good afternoon and welcome to another Market Matters video update, the first for 2019. First of all, Happy New Year to all of our subscribers and Happy New Year to you, James Gerrish.
Thanks, Harry.
Thanks for joining us today, James. You've made a few calls for 2019. I want to discuss those today for our subscribers. First big call, market struggled late 2018. You're calling it to struggle again in 2019. Do you want to expand on that for us?
Yeah, I think if you think about the 10-year bull market that we've been in since the bottom of the GFC, on the S&P 500, for instance, we've rallied from 800 points up to about 2,600 points or thereabouts. So that's a very, very strong rise over a long period of time. So we have seen a 15% correction in the US market in the December quarter. What I'm saying is that a bull market of that magnitude, of that length, doesn't simply end in a short amount of time. So you can easily envisage that 2019 will be a year where markets chop around and create a top, as opposed to one 15% correction in a 2-month period. I don't think that is what will signify a top in the market. So a choppy 2019, I think will probably grind up in the first quarter or two of the year, but ultimately a choppy 2019 is what we've been calling. So that sort of suits our way of investing, Harry.
Number two, which ties into that point, the elastic band of optimism and pessimism swinging from both ends. Is that what you sort of talk about when you see the markets chopping around this top?
Yeah, absolutely. And I think when, given what we've been through over the last 10 years, markets in that realm of optimism versus pessimism, that elastic band, it will go further than you think. So, 5,400 was probably more aggressive on the downside than we anticipated in December of this year. We were set pretty well in October, high cash levels, negative facing ETFs. We bought a little bit too soon. We'll put our hands up and say that. So I think that's an area that we're conscious of this year, that it can go both sides, on the downside and upside. So that has ramifications for how we'll position the portfolio and when we'll buy and sell things, but ultimately remain flexible. You want to be buying at extreme pessimism this year, I think, and you also want to be gradually selling as optimism builds. So we've started doing that this year as we speak, Harry.
That's right. Number three, the retail sector in Australia had a tough end of 2018. Is that going to continue into 2019? Yeah,
I mean, the premise, this isn't a really bold call. The majority of analysis I read out there is calling the downturn in retail to continue, etc. I think it has merit. I think it's it revolves around the indebtedness of the average Australian. Average Australian is obviously carrying a lot of debt if we think about it internationally, but also when we think about it domestically relative to incomes, etc. So, I think we're probably 6 months away from the bottom in the retail space. There's been a huge amount of carnage in that sector. I think there's value in that sector, but I would caution, and I did so in the Outlook report, just around buying them on historic earnings. They look cheap on historic earnings. They look cheap on analysts' expected earnings in FY19. But I'd caution that those earnings, I think, will be under pressure. So I think one more leg lower in retail would be, and those consumer discretionary stocks then might be that time to go in there and go against the grain and make a bold call and buy those. So they're on our radar, but just not yet, Harry.
Certainly. All right, the gold space, we saw some big M&A activity recently. How do you trade the golds this year?
Yeah, I mean, gold in Aussie dollar terms, I think there's two real spectrums here. So gold in Aussie dollar terms, which is pretty much a currency play, has been going gangbusters. So obviously the weakening in the Aussie dollar has benefited the Aussie dollar-based gold price. That's had a big influence on some of these mid-tier companies like Evolution, Regis Resources, etc. So look, I think the gold in Aussie dollar terms is near a high. So I'm looking for a retracement in that price, and ultimately, a retracement in the gold stock. So if that does retrace, though, will be buys into weakness in the gold space. So it's certainly one that's on our radar into weakness, not in the strength at this stage, though, Harry.
Sticking with the Aussie dollar theme, you've got a bold call for the Aussie dollar for 2019. Run us through it.
It's not that. I mean, if I go back 12 months or so, we're calling the Aussie dollar down to sort of the mid-60s from above 80. What I think there now is the majority of that call has played out. So, we had a flash down to 67 in the Aussie dollar recently. It's trading around, above 70 at the moment. But I think, from a risk-reward play, the big move on the downside in the currency has played out. If you think about what the market's now predicting, it's predicting about a 50% chance that the next move in rates is going to be down for the Aussie market. I think that's probably overplayed at this stage, and that's feeding into weakness in the Aussie dollar. So I think the Aussie dollar is near a low. I don't think we'll get a rate cut in Australia. I don't think that'll stimulate the economy as much as people may suggest. So I doubt we will get a cut there unless housing really falls out of bed. Again, I don't think that will happen if the lessons through the GFC, people continue to service their mortgages through the GFC, etc. So I don't expect a huge rout in Aussie property. Therefore, I don't expect them to cut rates. The fact that the market's now pricing that in is more bullish than anything for the Aussie dollar. So I think we're nearer a low than anything there, Harry.
All right, macroeconomic picture. We remain cautious on it. We got China data out later today. US data's been strong. Euro data's been weak. What's the macro outlook for 2019?
Yeah, this is going to be really key China data. It's out in about half an hour in Australia. So GDP amongst and a bunch of other stuff coming out of China. So my main concern is if I look globally, economic momentum is starting to slow. US earnings have been a big driver of this rally over the last few years. Particularly last year, it was spurred on by Trump's tax cuts. It was spurred on by a number of other factors that may not be there this year. So I think that's a concern for us. So the US being the driver of economic momentum, starting to show signs of weakness. We've had a lot of talk about the potential inversion of bond yields, the flattening of yield curves, etc. So that does imply, I look at the bond markets, it does imply that the economy is going through a potential flat spot into the future. So earnings drive markets over time. Earnings are starting to peak out, so I think markets start to peak out. The other thing is around corporate buybacks. So it's the cost of capital increases, which we've seen in the US. Then buybacks in corporate America become less attractive, and they sort of dissipate from the market. It was a piece I wrote about last week. Harry.
All right, the European-facing stocks. We've got a couple in the portfolio. We're looking at a couple more. You're calling to avoid them for now.
Yeah.
Run us through that talk.
I think it's all too hard. Simple. Keep it simple, stupid in that instance. I think with Brexit and what's playing out in Europe, I think European-facing stocks are too hard. They're cheaper than the US stocks, but earnings are so clouded because of what Brexit's delivering over in that part of the world. So we're in a void for the moment, Harry.
All right. We talked about the elastic band before. Cut losses and run profits is the mantra for market matters in 2019. What are your thoughts there?
Well, I think you need to, as the bull market matures, I think you need to tighten up your money management, and that's in terms of being more aggressive in cutting stocks when they're losing money, but also letting those winners run. I think that's an area that we can improve on from last year. I think we left some money on the table, and I think we left some of our losers run a little bit too far. So I think that's going to be one of the focus areas. I think it'll serve us well in 2019, and we've got off to a pretty good start this year. The portfolio is performing better than the market. We're now up in positive territory with the market still being in the red. So we're pretty pumped for 2019, Harry. I think it's going to be a good year. It'll be a challenging year. But it'll be a year where we need to keep our fingers firmly on the pulse, and that's what we intend to do.
Fingers on the pulse. A big year ahead for markets and a big year ahead for Market Matters. Thank you for joining us today.